November 2024. Warren Buffett makes a move that sends shockwaves through the investing world. Berkshire Hathaway's cash position hits $334 billion. That's not a typo. $334 billion sitting in cash and treasury bills. More than Apple, Amazon, Alphabet, and Microsoft's cash combined. More than Berkshire owns in actual stocks. The Oracle of Omaha, the man who built a fortune by being greedy when others are fearful, is sitting on the sidelines, and he's been selling. 9 consecutive quarters of net stock selling. Over $174 billion more sold than purchased. He dumped 67% of his Apple stake, cut Bank of America by 34%, even stopped buying back his own company stock. But here's what should terrify you. This isn't the first time. In 1999, Buffett built a massive cash pile while everyone else piled into .com stocks. The Nasdaq crashed 78% over the next 2 years. Buffett, minimal losses. In 2007, his cash reserves hit record levels. The 2008 crash devastated portfolios worldwide. Buffett, he made $10 billion buying distressed assets. The pattern is undeniable, and it follows the same 3 stages every single time. This is the story of Buffett's crash playbook, a repeating pattern across 25 years of market cycles. And right now, in 2025, we're deep into stage 3. Let me show you the pattern. It's mechanical, it's predictable, and once you see it, you can't unsee it. Stage 1, the buildup. This is where Buffett starts accumulating cash while markets are still rising. He's not selling in panic, he's selling into strength. Most investors don't notice because they're too busy making money as stocks climb higher. The key indicators: cash as percentage of total assets begins climbing. Net stock sales exceed net stock purchases. Berkshire slows or stops share buybacks. The Buffett indicator, market cap to GDP ratio, pushes into overvaluation territory. Stage 2, the acceleration. Cash accumulation speeds up dramatically. Buffett starts making headlines for hoarding cash and missing out on gains. Critics call him old-fashioned, out of touch, past his prime. The market keeps climbing, proving the doubters right temporarily. The key indicators: cash doubles within 12 to 18 months. Major stock sales make news, Apple, Bank of America, etc. Berkshire stock begins outperforming defensive, not offensive. Cash as percentage of assets reaches historic highs, 60% plus. Stage 3, the warning. This is the stage that matters most. Cash sits at record levels, Buffett stops deploying capital, the market feels invincible, and that's precisely when it's most vulnerable. The key indicators? Cash position reaches all-time highs. Buffett makes public statements about high valuations. Berkshire's performance diverges from the market, often underperforms during this stage. The waiting game begins. Buffett is ready to pounce when the crash comes. And then, the crash happens. Stage 4 isn't part of the pattern, it's the payoff. Buffett deploys his cash mountain into distressed assets at fire sale prices, emerging wealthier than before. Now let's see how this pattern played out historically and why 2025 looks eerily familiar. Let's go back to 1999, the height of the .com mania. Pets.com goes public and soars despite never making a profit. Stocks with .com in their names double overnight. Day traders quit their jobs to play the market. Everyone's getting rich except Warren Buffett. Stage 1, 1997 to 1998. The buildup. Buffett begins accumulating cash. He's criticized for not understanding technology. Berkshire stock underperforms as tech stocks soar. While competitors chase .com dreams, Buffett holds about $15.5 billion in cash by 1999. Stage 2, 1999. The acceleration phase hits. Critics savage Buffett. Barron's publishes a cover story questioning whether Buffett has lost his touch. The market cap to GDP ratio, Buffett's favorite valuation metric, hits 146%, far above historical norms of 55 to 75%. Buffett doesn't care. He writes in his annual letter, "We continue to do little in equities. The availability of opportunities varies enormously, and when that's poor, as it is now, we simply do nothing." Stage 3, late 1999, early 2000. The warning. By early 2000, Berkshire is sitting on massive cash reserves. The tech bubble has reached absurd valuations. Companies with zero revenue have multi-billion-dollar market caps. Buffett delivers his warning at a Sun Valley conference in July 1999. He presents his market cap to GDP analysis, showing the market is grotesquely overvalued. Nobody listens. The party's too good. The payoff, 2000 to 2002. March 2000, the Nasdaq peaks at 5,048. Then it collapses. By October 2002, the Nasdaq has fallen 78%, from 5,048 to 1144. Trillions in wealth evaporate. Buffett, he held cash through the crash, then deployed it methodically, buying quality businesses on the cheap. By 2002, his cash position peaked at 70% of assets, and he used it to build positions that would compound for decades. The pattern worked, but would it repeat? Fast forward to 2007. The housing bubble is inflating. Credit is easy. Banks are leveraged 30 to 1. Subprime mortgages are packaged into AAA-rated securities. Everything seems fine, except to Warren Buffett. Stage 1, 2005 to 2006. The buildup. As early as 2005, Buffett warns about housing. He tells investors, if you keep marking something up, housing, and the payment comes from someone else who feels they are bearing no risk because they have the government guarantee, the money can just flood in. Cash starts building. Buffett's not buying the housing story. While others leverage up, Berkshire's cash reserves grow to $44.3 billion by 2008. Stage 2, 2007. The acceleration. By 2007, cracks appear. Foreclosures tick upward. Bear Stearns hedge funds collapse, but home prices remain elevated and credit stays easy. At Berkshire's 2007 annual meeting, Buffett delivers a cryptic warning. You'll see plenty of misery in that field. Cash acceleration continues. The market cap to GDP ratio hits 137%, overvalued but not as extreme as the dot-com bubble. Buffett positions defensively. Stage 3, 2008. By mid-2008, Berkshire's cash position has swelled to unprecedented levels. The percentage relative to total assets reaches highs not seen since 1987. Then September 2008 hits. Lehman Brothers collapses. Credit markets freeze. The S&P 500 plunges. Panic consumes Wall Street. The payoff, 2008 to 2009. While everyone else is selling, Buffett is buying. In October 2008, at the peak of the crisis, he writes an op-ed in the New York Times. Be fearful when others are greedy, and greedy when others are fearful. He deploys $20 billion, $5 billion to Goldman Sachs, preferred stock plus warrants, $5 billion to Bank of America, converted to 679 million shares worth $21 billion by 2017. Billions more into distressed assets. The investments generate over $10 billion in profit. The pattern worked again. But the most important test was still to come. Let's move to 2019. The longest bull market in history is running. Trump tweets move markets. Everything is hitting all-time highs. FOMO is everywhere. Warren Buffett, building cash. Stage 1, 2018 to 2019. By mid-2019, Buffett's cash pile hits $122 billion, the most since right before the 2008 crisis. As a percentage of assets, it's approaching warning levels. Market cap to GDP, over 140% and rising. Buffett's not buying anything. Critics say he's lost his edge, too conservative,
missing out on the longest bull run ever. Stage 2, late 2019, early 2020. The acceleration. Cash keeps building. Berkshire becomes a net seller. The buyback program slows. Something's off. Then COVID-19 hits. February, March 2020. The S&P 500 crashes 34% in 33 days, the fastest bear market in history. Stage 3, March 2020. The realized warning. This time something different happens. The crash is so fast and the Fed response so massive that traditional bargain hunting becomes complicated. But Berkshire's cash position, built over 18 months before the crash, protected Berkshire. While portfolios were destroyed, Berkshire held steady. The defensive positioning worked. The payoff? 2020 to 2022.
Buffett didn't make the massive crisis bets like 2008, but the pattern still worked defensively. During the 2022 bear market, according to SEC filings, Buffett deployed over $50 billion into stocks, one of his most aggressive buying sprees since 2008. He scooped up Chevron, Occidental Petroleum, Ally Financial, and others as markets dropped. 3 crashes, 3 times the pattern worked. But now comes the real question: is it happening again? November 2024, Berkshire Hathaway reports third quarter earnings. Cash and treasury bills, $334 billion. By March 2025, it climbs to $348 billion. Let's check the pattern. Stage 1 completed. 2022-2023. Cash accumulation begins. Net selling starts. October 2022 through March 2025, 10 consecutive quarters of net stock sales. Over $174 billion more sold than purchased. Stage 2 completed. 2024. Acceleration phase. Major headlines. Sold 67% of Apple stake, from 906 million shares to 300 million. Reduced Bank of America by 34%. Cash doubled from $167 billion to $334 billion in 1 year. Stopped share buybacks for 5 consecutive quarters. Stage 3, we are here. 2025. The warning signals are flashing. Cash position, $348 billion as of March 2025. As a percentage of assets, it's at levels only seen before major crashes. The Buffett indicator. Market cap to GDP ratio now stands at 209%, an all-time high. Higher than the 1929 peak. Higher than the 2000 dot-com bubble, 146%. Higher than the 2008 housing bubble, 137%. Shiller P/E ratio, 38.35, indicating 116% overvaluation compared to historical norms. Buffett's own actions. In February 2025, Buffett defends his cash position in his shareholder letter, but his actions speak louder. He keeps selling. He keeps waiting. Then, March-April 2025, markets begin correcting. Tariff uncertainty, economic concerns. The S&P 500 drops 11%, while Berkshire stock rises 12%. The divergence is the tell. When Berkshire outperforms during market stress, it means the defensive positioning was right. We're in stage 3. The question isn't if Buffett will deploy this cash, it's when and at what prices. So what do you do with this information? First, understand what this pattern is not. It's not market timing in the traditional sense. It's not a prediction of when a crash will happen. It's not a guarantee of anything. What it is, a valuation discipline framework, a pattern of preparation, not prediction. A reminder that cash positions provide options when others have none. Buffett isn't predicting crashes. He's recognizing when valuations make future returns unlikely and positioning to capitalize when fear creates opportunity. The 3 lessons. Lesson 1. Valuation matters over time. When the Buffett indicator hits 200% plus,
When the Shiller PE exceeds 35 plus, when euphoria dominates, expected future returns compress. Buffett doesn't predict timing, but he respects math. Lesson 2. Cash is a position, not a mistake. Holding cash when assets are overvalued isn't missing out. It's waiting for opportunity. Buffett's cash earns $12 billion annually in treasury yields right now. That's not dead money. Lesson 3. The pattern works because Buffett has the discipline to execute it. Most investors can't do this. They can't sit on cash while markets rise. They can't ignore critics calling them old-fashioned. They can't wait years for the payoff. But Buffett can, and does, every single cycle. In 1999, Buffett built cash before the dot-com crash. In 2007, he built cash before the financial crisis. In 2019, he built cash before COVID. Now, in 2024 and 2025, he's sitting on $348 billion, the largest cash position in Berkshire Hathaway's history. The three-stage pattern has completed. Build-up, acceleration, warning. Does this mean a crash is coming tomorrow? No. Buffett held cash for years before the dot-com bubble burst. He sat on billions while critics mocked him for missing out. But when the crashes came, and they always do, he was ready. And those who followed the pattern, who respected valuation, who maintained discipline, emerged wealthier on the other side. The pattern doesn't tell you when. It tells you to be prepared. Because one thing is certain, Warren Buffett didn't build a $348 billion cash pile to let it sit forever. He's waiting, and when the opportunity comes, he'll deploy it all. If this breakdown of Buffett's three-stage pattern opened your eyes, here's what I need. First, subscribe. We break down strategies and historical market patterns every single week. Second, comment below. Which stage do you think we're in? Are we still in the warning phase, or has the opportunity already started? I read every comment. Third, share this with someone who's wondering whether to keep buying stocks at these valuations or wait like Buffett. Because understanding how the greatest investor of all time navigates market cycles isn't just interesting, it's the difference between surviving crashes and profiting from them. I'll see you in the next one.